Dear investor, in this edition, let us look at the following. Budget 25 key takeaways, quarter one result season, US elections and possible outcomes and impact on India. And yes, this continues to be time for alpha. We'll also talk of FPI flows, Chinese market, and our markets. And of course, valuations. Now, coming down to the first topic, budget takeaways. Indian budget saw government's big focus on fiscal consolidation, as fiscal 25 deficit was budgeted at just about 4.9% versus 5.1 in the interim budget in February 24. And a roadmap to bring it down to 4.5% in FY26 was reiterated. The COVID years saw a sharp spike in fiscal deficit, and the same is now being corrected. The actual numbers realized could be better because the tax to GDP ratio is assumed to be 1. So if GDP grows nominally by 11%, tax is supposed to be growing at the same number, while the trend has been that of an improvement with all the reforms we have seen in the past. Contrary to expectations, there have been no change in subsidies, which as a percentage of GDP continues to drop, while in absolute terms they are preserved at last year levels. Capex spends continue to gain market share. Rural spending remains weak. The large RBI dividend was partly used to fund support to Bihar, for new roads, power projects and flood control, and Andhra Pradesh for the new capital, and the rest was used for fiscal consolidation. As compared to the interim budget, no extra allocation has been seen in defense and other capex items. This is a year for consolidation of this pace after strong growth over the last 2 years. Quantum of capex done can still show momentum if more BOTs are done, which should be enabled with much better corporate balance sheets. While overall capex numbers have not moved much versus the interim budget, provisions for Pradhan Mantri Awas Yojana, renewable energy and roads have seen an increase, while PM Sinchai Yojana has seen a cut. In defense, the biggest increase is seen in the aircraft's head. Overall capex of center, states and CPSC put together is expected to remain at 6.1% of GDP, implying growth rates to be in line with tax collections. Tax buoyancy continues to be good. Q1 tax collections are over the assumptions taken for FY25, and we do expect a positive surprise on this count. RBI's dividend is reducing the stress on borrowings. Helped with sustained FPI flows on debt side, we should see a downward pressure on bond yields. A hike in both short-term and long-term taxes on equity is a clear negative. However, now that LTCG rates have been harmonized across asset classes, the threat of an adverse change on this count is low in future. Since equities pay STT nil for other classes, the lower STCG should also continue in the future. If it happens, a big overhang goes away from the market. The higher taxation in India would reduce the effectiveness of India as or attractiveness of India as an investment destination for FPI. Herein, the attractiveness of GIFT City route to invest into mutual funds would increase. The removal of inflation indexation will impact investment attractiveness of premium real estate based on price compounding achieved. So it is different for different cohorts. Ballpark real estate prices compounding of over 10% is beneficial for investors versus the older regime and vice versa. Urban consumption has been given a fillip by reducing income taxes. There is a clear focus on job generation. The government has revealed a new employment subsidy, which should also aid some low-end discretionary consumption. Overall, the budget doesn't change the direction for any sector. The changes are small. No changes. For example, in cigarettes are being celebrated. Jewelry should see better tailwinds of formalization on reduced import duty. So the gap between non-duty paid imports and fully duty paid imports reduces. PLI allocations have moved up to 133 billion rupees, and many spaces would wait in anticipation of further clarity as to where the government wants to catalyze investments. The change in capital gain structure increases the relative attractiveness of mutual fund platform to investors to participate in the equity markets. We expect equity inflows into mutual funds to hence remain strong going forward. Change in STT taxation does impact the arbitrage funds marginally, but they would retain their competitiveness. So no overall impact on AUMs on this count. Overall, the outlook on these sectors has not changed. Coming down to the next topic, Q1 result season. Q1 result season is on. 45 companies tracked by us have delivered results as of 23rd of July. Overall results have delivered a miss of 2.2% versus already muted expectation of a 2% decline in PAT. Ex OMCs, profit after tax is up 6% versus expectations of 7%. As far as Nifty is concerned, ex OMCs, so there are 13 companies which have delivered numbers. PAT is up 7% versus an expectation of 8%. Miss is mostly on account of commodities. Earning downgrades have been more than upgrades. The period of high profit growth is behind us. We believe that going forward, the higher growth delivering companies would start to command a growth premium over others as growth becomes scarce. It could also mean that the value part of the market, where growth quotient is low, could peak out after 4.5 years of strong outperformance. Coming down to the next topic, Chinese market, FPI flows and the rally in India. Well, Chinese market has again started to show weakness. The strength in the Chinese market during the Feb to mid-May period sucked in FPI liquidity from all over the world. India also experienced outflows during the period of Feb to May. Now the Chinese market has started to show weakness. From the peak in May, it has dropped 10 to 15%. India has again started to get consistent FPI inflows. This was over $3 billion in June and has crossed that level by the third week of July itself. Along with this, India continues to see very structural, strong domestic flows. June saw over rupees 41,000 crores of inflows into mutual funds. Continuous domestic flows help sustain the stability in the market, while if FPIs also turn buyers, the positive momentum in the market increases. Last 3 months have seen Indian market perform relatively strongly. Now, FPI flows into debt markets have also picked up after inclusion in JP Morgan Bond Index. Positive FPI flows, both equity and debt, have helped in helping the country achieve record levels of forex. 10-year bond yields have declined to just below 7% versus 7.2% in May. Coming down to the next topic, US election impact. So while it is still some way off, it would be held in November. It is possible there is a regime change back to Trump. This may have some impact on our markets. Let's examine the same. First is the thought of lower crude prices. Trump is expected to focus on higher US oil production. This should put a downward pressure on oil prices. Downward oil prices is good for manufacturing margins and India in general. In terms of global sentiment, again, India benefits since we are the largest oil importing country. Second thought is end of Russia-Ukraine war. Trump has been in favor of a negotiated settlement of this war. If this happens, then again the risk premium on oil would reduce and oil could get cheaper, which is again good for India. However, Russia-Ukraine war ending may impact the sentiment towards defense companies. While we believe as a learning, defense expenditure will continue to be high for several years in India and around the globe. India has been more focused on Chinese presence on our borders, and the threat remains. The narrative of China, Taiwan also remains. Moreover, Ukraine, if there is a negotiated settlement, would have to cede a large territory to Russia, close to 18-19% of its overall, an outcome that is not easily digestible. This may be the first instance of a large territorial siege after World War II and has implications for other global areas such as Taiwan. No longer the global guarantee would hold. Hence, we do expect the defense build-up globally to be maintained at a level higher than what we have seen in the past. The other point is lower US dollar. Post-elections, we may see steps in the US to weaken the dollar versus other currencies to help in American manufacturing and exports. Now, lower US dollar is again positive for emerging markets, and Indian equity market should benefit. On the other side, not so positive, there can be a deal with China on semiconductors. While there is a strong anti-China sentiment currently, and this is helping Indian manufacturing, Trump in fact started the anti-China thought process. However, there is a thought that he is also a pragmatic businessman, a deal maker, and can change his position, particularly in the space of semiconductors. This may weaken the anti-China thought process and consequent outlook on the stocks benefiting from the same across the world. However, the cooperation is expected to be limited to a few spaces, mostly semiconductor, and we do believe the overall disengagement would continue. Our thought is that overall an US election outcome would either be status quo or better for the direction of Indian markets, though some sectoral leaderships may change or may see some valuation correction. Coming down to the next topic, this continues to be time for alpha. Now, Q1 result season is on. In this result season, growth rates of profit of India Inc. is seen to drop. IT and banks, two spaces that make up close to 50% of the index weight, are expected to deliver lower than index earnings growth. Earnings growth, which seemed to be omnipresent a few quarters back, would be at a premium as we go forward. This makes us believe that the value trade may be getting over, as after 4.5 years of strong performance, in the absence of earnings growth, continuing the momentum should now become increasingly difficult. As earnings growth gets limited to a smaller part of the market, we believe that this part would get a premium versus others, in line with our belief that markets follow earnings growth. Our portfolios are built of high sustainable growth companies, and we believe are well placed. Coming down to the last topic, valuations and upsides. Well, markets have done well over the past period. Valuations are clearly higher than long period averages in most parts of the market, maybe barring banks. However, with higher growth outlook, higher valuations should sustain. We had shown earlier that a 1% higher earnings growth for a period of 10 years bumps up valuations by 5%. India Inc. retains its positive outlook by and large. This being the case, we do expect only a time correction rather than any sharp drop in the market, and expect investors to make use of any dips in the market. So those are our views. Do expect some amount of consolidation for valuation correction to happen over a period of time. Thank you all. Happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.